So now to look at factors to consider when buying REITs, the number one thing is that you need to consider how long they have been in the game, like they've been listed or like they've been established. Because just like with any company on the stock market, they must have a proven track record that they've been around for the longest time and they've been paying dividends and they have had great capital growth. So with REITs, because we are investing in them for income and we are hoping that when you retire, when you now want to retire at 40 or 60, they still need to be giving you dividends. They need to prove to you that they have been paying dividends for the past 20 years and they have been consistent with that. That is why it's very much important that you get to consider for how long they have been in the game. And in as much as history does not tell us what's going to happen in the future, it is a good indicator, right? Because if now, for example, there is this REIT that owns malls, the malls have been around for 20 years. They're not going anywhere, those malls. They will always be there. So we're just hoping that that REIT is going to continue managing the property well, managing their finances well, and they will not lose those malls. You get my point? So it's very much important that you get the history of that REIT that you're investing in. And the second thing to consider is the net operating income. This is the profit. Remember, dividends are paid from profits, right? This company must go and sell their property to whoever, and that person must pay them. And when they pay them, that now is being turned to profits. So REITs have to be profitable. If they are not profitable, the problem is that one day you will wake up and you're not going to get paid dividends because dividends are paid from profits. So if this REIT is not profitable, how are you going to get your dividends? And another thing to consider is that you should not just invest with that arrogance to say, as long as I'm getting paid. Okay, you might be getting paid, but the question is, does this REIT afford to pay you dividends? Because the problem is that if they do not afford to pay dividends, if they are not profitable today and they pay dividends today, it's a question of where do they get money to pay those dividends? You could find that they're taking debt to pay you dividends to make you happy, but then the business, the company is not doing well, and the risk is that they might go insolvent one day. They might be delisted. Your shares will be losing value and you're going to actually realize those losses because when they now say they are delisting, you're going to want to sell your shares and you'll sell them at a loss. That is the problem. And another link there is that when a company is not profitable, the share price tends to reflect that. It's going to go down. So a share price is actually a reflection of how good the company is doing financially. So if you are just happy to receive your dividends, you don't care how the company is doing, one day it's going to catch up with you. And it's going to be very sad that you're going to stay invested in a company that you are okay with receiving dividends, but then the share price continues going down because they are not profitable. So you need to consider the company's profitability to see if it's even increasing. They can be, but then are they increasing their profits? And that is very important, honestly, because there must be an increase. And the last one to consider is the occupancy rate. This is way too important because this determines the profit. You know, there's a REIT that has apartment buildings, right? But nobody's staying there. How are they going to make money? And how are you going to get paid, right? So all of these things are linked and you cannot look at one in isolation. You might look at their financials and say, oh no, like they're profitable. But now when you check their occupancy rate is declining. You know, it cannot be, because if now it's declining, it means that that REIT is no longer in demand. And one day it's going to go out of business. So the occupancy rate must be reasonable. It cannot be at like 60%, you know, like let it be maybe at like 90, somewhere there. Whatever that is that you are comfortable with, and also considering the profit that they're generating from that occupancy rate.